Welcome to the Lifestyles Unlimited Real Estate Investor Radio Show, a real estate investment program. Listen and learn how to use real estate to build wealth and passive income streams for you and your family. We bring you experts every day to discuss and answer your questions on everything from single-family homes all the way up to 600-plus unit apartment complexes. And now, the Lifestyles Unlimited Real Estate Investor Radio Show.
Welcome to the show. My name is Al Gordon, and as always, we're working on your financial freedom. I'll tell you what, I am tired today. I am absolutely tired. I'm exhausted. I really am. And it wasn't because I've been partying all the weekend. I wish that were the case, but that's not the case. No, I just completed phase 1 of a 3-phase relocation. You heard me correctly. Phase 1 of a 3-phase relocation is now in the books. What am I talking about? Okay. Prior to the July 4th weekend, Tina and I made a decision that we wanted to tap into the equity in our home. And we wanted to get it all out. We wanted to get all of that equity out of our house. And the reason for it is we know that we can repurpose all of that money into different types of real estate assets. And by doing so, it'll change our financial position significantly. You heard correctly. I used the word significantly. So prior to July 4th, we formulated our plan to sell our property. Now, our property was in pretty good shape. I mean, we take care of the house that we live in. As a matter of fact, about 2 years ago, we spent about $50,000 to really give the property a facelift because it needed it. It really did. It had been built in 2005. So after 14 years of the Texas sun, the paint was a little faded. The landscaping needed some help. The backyard had never been touched by the original owners. And we really didn't mess with it either because, in our opinion, the showcase of the house was the front yard. Yeah, the front yard we had this massive porch with this incredible view across the valley. And it was just a great place to sit. And because it was easterly focused, you could sit there in the afternoon because the sun was blocked by the house. And it just made for a really, really nice place. When we bought the house, all of the land behind us was unimproved, meaning all of the natural vegetation that had been growing there ever since, it started growing there was there. So our backyard view was mostly oaks and some cedar trees, and it was kind of like a little forest back there. So it was very nice. But a little over a year ago, the individual that owns that land decided it's time to develop it. It was time for them to put in the final phase of a multi-phase housing tract that went in behind us. So one day we woke up and there were these massive machines behind our house, literally ripping the trees out of the ground and then stacking them up. And that occurred for a while, and then eventually they cleared all the land. And then they came in and they started to terrace the land because the land behind my house was of a higher elevation, thereby giving the lots that they terraced out actually the same great views that we had from our front yard, only a little bit higher and a little farther back. And that was, I think that was the showcase for that developer was, they were going to be able to sell, finally, these viewed lots in that subdivision. Well, eventually they started building houses. And they built these houses, and we started watching them go up. And we just didn't like the idea of having literally people in our backyard because we had never had people in our backyard. So Tina and I looked at each other, and we decided this must be a sign that it's time for us to move on. As a matter of fact, the neighborhood had been changing over time. There were people moving into the neighborhood that, I'll just say it. They felt like everybody owed them something. And I'll tell you what, that's not the cloth that I am cut from. Yeah, they talked about wanting to put speed bumps into the neighborhood to protect their children. Not quite understanding that when they bought into that neighborhood, there were no speed bumps there. So the expectation to put speed bumps in was kind of ridiculous. But there were enough people that decided to raise their voice and stir up a fuss over speed bumps. Well, I wasn't interested in speed bumps in my neighborhood because I am of a firm belief, that speed bumps are from the devil, that they don't really solve any problems. They just create problems in the neighborhood. So based on all that information, Tina and I decided to sell our house. And over the July 4th weekend, we went on the market. Now, if you've listened to the show before, I've pretty much told you the whole process from the time we started to sell the house to the point where we actually got a ready, willing, and able buyer that was able to perform. That process took us about 2 weeks. It did, because we had people that wanted to buy, and then once we pressed them on their ability to perform, well, we found out they couldn't perform, and, we just tossed them aside until we actually found the right people to buy our house. Well, yesterday afternoon, we did our final walkthrough with the family that is buying our house. And it wasn't just mom and dad that showed up. It was the 4 kids also. Oh, and grandpa and grandma weren't. I'm not sure which side of the house, whether it's mom or dad's side of the house, but they came there too. And they were just super excited about getting ready to move into our house. We had found the absolute right people to buy the property. They absolutely love the house. And I'll tell you what, it is such a blessing to us to know that we are passing on what turned out to be a very great place for us to live to a family that's absolutely just excited about living there as we were. So everything worked out just fine. I'm a little tired from moving stuff all weekend, but I do have some good news to report. When we come back from the break, I'm going to share with you the financial windfall. Stick around.
We're back with the Lifestyles Unlimited Real Estate Investor Radio Show. We're here to answer your questions and help you become financially free.
Welcome back to the show. All right, so I promised you I was going to talk to you about the massive windfall that we made on the sale of our primary residence. Yeah, we actually made money on the sale of our primary residence. But I'm the first guy to tell you that even though my house made me some money, and because I've lived in that house for at least 2 of the last 5 years, heck, I've lived in that house for the last 8 years, I qualify underneath the tax provisions that the government gives you to exclude up to $500,000 in capital gains from being capital gains. Yeah, I get a $500,000 exclusion because I am happily married. Yeah, technically, Tina gets $250,000, I get $250,000, so we're not going to be taxed on the first $500,000 of gain. So that's not bad. That's not terribly bad. But let's actually analyze the money that I made. Are you interested? Because I want to prove to you that there's a better way to make money. That there's a much better way to make money than just buying your principal residence, living in it, and hoping it goes up in value. Now, I will grant you that you have to pay money to live wherever you're going to live. Whether you choose to rent, whether you choose to own, it's going to cost you money out of your pocket to occupy real estate and live in it. Yeah, it's just a fact of life. That's just the way our culture and our economy works. Yeah, I mean, I guess, you could join the ranks of the homeless. I mean, that's one course of action. I don't recommend it. Or you could be like those people on, Discovery Channel, that those extreme people that go out and live off the grid. I mean, you could do that too. I don't recommend that either. But at the end of the day, it's going to cost you money to live somewhere. So we made a decision to buy a house. When it came time for me to get ready to retire from the military, we made an informed decision to buy a house because we felt that real estate would go up in value, and we at least wanted to get something out of it, per se. The other thing that you get by owning a house is you get to write off the interest that you pay on the mortgage. Now, there are some limitations on whether or not you can do that based on whatever your tax circumstances are, but at least you get an additional write-off, which may or may not make any difference anymore since Trump just basically said, hey, everybody gets like 24,000 married, which tends to be better than what people were trying to write everything off. Yeah, so it's like Trump basically said, okay, we're just going to make this easy for you guys. So we sold our house. We close escrow today. As a matter of fact, when I'm done with this radio show, I'm going to get in my truck with my wife. We're going to go over to the title company. We're going to sign all of the paperwork granting the deed to our buyers. They will become the official owners of that property today, and they will begin their journey in that house as a family of 6. I don't know, maybe it's 8. I mean, Grandma and Grandpa were there. I don't know. It's a big enough house. It could accommodate all of them. And when I leave escrow, I'll be leaving escrow with, well, I would say a check, but I'm not going to have them give me a check because then I would actually have to go to my bank and deal with my bank, and I don't want to do that. So I'm going to have them just wire the proceeds into my account. Yeah, I'm just going to have them wire the proceeds into my account. And you're wondering, okay, get to it, man. How much money you making? $200,000. That's essentially the gross profit on that house, based on the fact that I bought it for what did I pay for it? I bought it for $405,000 8 years ago. I am selling it for $652,000. So when you take the cost of sale away, you take what I paid for it away, it leaves you with gross profit. Now, I'm using the term gross profit because there's something I actually have to factor in. It's all of the money that I put into that house while I live there. So what does that amount to be? Well, we did a major renovation on the property about 2 years ago. That entitled completing the backyard. So we put in a large wooden deck. We put in a covered patio. We put in like a 10 by 16 storage shed so that we can move all the stuff that should be in the shed out of our garage. We did a complete re-landscaping of the front yard. We did some landscaping in the backyard to include these giant trees along the back fence so that, we wouldn't have to look at the houses that were going to be built there. We also had the house completely painted on the exterior. We did, we put in gutters because there were no gutter systems. We completely redid the front porch railing for the steps and everything that go down, and it was $50,000 when the dust all settled. Now, prior to that, when we bought the property, my wife had all the flooring, except for one small portion of the house. All the flooring came out. Yeah, because it was nasty. They had carpeting in the property. They had animals that, used the carpeting for the bathroom. And even though they cleaned it the best that they could, as soon as my wife walked into the house, she could smell that there was animal waste, in the air. So all the carpeted areas, well, they got ripped out. The places where there were tile, except for one small place in the house, all the tile was taken out. And we put in brand new tile throughout the house. We're talking about 3,500 square feet of tile. That was expensive. Yeah, to do all the flooring was expensive. We also repainted the interior of the property. So, I mean, when you add all of those costs together, not to mention that, we had to replace a couple of water heaters that were getting ready to go bad. I decided to take those out, replace those with tankless water heaters, or a tankless water heater to replace those two. We had some appliances go out that needed to be replaced that were built in. It was about $100,000 that we've dropped into that house. So, when the dust all settles, you take that gross profit of $200,000, you subtract $100,000 in improvements that I put into the property, and really, I'm only making a net profit of $100,000. When you break that down over the 8 years that I lived in the house, we made $12,500 a year on the appreciation. Now, that's not bad. It's not bad. I mean, it's not terrible. But when we come back from the break, I'm going to explain to you a better way to make so much more money than living in a house. Stick around.
Welcome back to the Lifestyles Unlimited Real Estate Investor Radio Show. Now, let's get back to your map to financial freedom.
Welcome back to the show. All right, 10%. Yeah, 10%. That was the effective return on investment that I made on my house. 10% per year. Now, I will tell you, that's not a bad number. I mean, it's not a bad number when you consider appreciation and things like that. But ironically, it's not that good of an investment. It's not. It's not a good investment at all. Look, I gotta let you in on a secret. Technically, 10% would have been probably what you would have made on this property, because you probably would have bought this property by putting 20% down. In other words, you would have dropped $81,000 into the house. That's what my down payment requirement would have been. But as a qualified veteran, I had the ability to buy a house and finance 100% of it. That's one of the benefits that I receive from the Department of Veterans Affairs. And they essentially guarantee the lender that if I screw up and they have to foreclose on me, the lender's going to be made whole. Yeah, so this basically the federal government is saying, look, we'll cover down on the first 20% of that loan. So that makes the lender feel better. But if I hadn't been a veteran, I would have put $81,000 down on the house that I buy. So technically, my rate of return is infinite because I really didn't put any money into the house other than the $100,000 in improvements that I made to the house. But if I had bought it the way most people buy their primary residence with 20% down, my appreciation rate of return on that property would have been right around 10%. Okay, so not terrible, right? Not terrible. Well, let's take a look at it from a different perspective. Let's look at it from the perspective of, what if I had taken that money and I had bought real estate with it? Yeah, what if I just bought real estate with it? Let's spin it around, because I probably have you like totally confused now, because like you're going, well, wait a minute, you didn't put any money down. You're right, I didn't. If I had put $81,000 down, my rate of return on that money based on appreciation was 10%. But what I could have done is I could have elected to just go rent. I could have elected to just go rent a property. As a matter of fact, the cost for renting a property probably would have been a whole lot less than my monthly mortgage payment. Yeah, because my mortgage payment was reasonably high. And when you look at principal, interest, taxes, and insurance, my mortgage payment was up there a little ways. I could have rented, paid a lot less, and that would have significantly improved my monthly cash flow. But we as a family decided to do something different. We decided to own our house. So when you take into consideration the rent versus buy piece, you also have to look at, there's a pretty good chance that by renting, I may have saved myself $12,000 per year, like $1,000 a month in costs that I wouldn't have been spending on that house. And that has a different impact on your requirement to meet your household requirements every month. Yeah, so in other words, it potentially could have cost me $1,000 a month less to operate my household. Meaning the number I needed to get to where I could consider myself retired would have been a smaller number to tackle. So what I'm getting at is I could have possibly retired in less than 2 years, but it took me 2 years to get there. It's all good. So what if I had taken $81,000? Or what if you had? What if it was you that had $81,000 in your hand and you're thinking about paying $405,000 for a house to live in? What if you took that $81,000 and instead of buying a house for you to live in, you buy a house that is in bad shape, you fix it up, you bring it back to the quality standard that it should have, and then you make that available to somebody who wants to live in a great place. Let me just tell you about, and I'm not even going to go back 8 years, because 8 years ago, trust me, $81,000 would have bought you a lot of houses because the market was different 8 years ago. As a matter of fact, 8 years ago, people were hemming and hawing over the price of real estate in a lot of the Texas markets because they thought, wow, it doesn't go up in price. It doesn't appreciate that much. We shouldn't invest there. That'd be a bad investment. And that right there is bad thinking. 8 years ago, in a lot of the markets that we're investing in today, you literally could pick up houses for less than $10,000 a house, cash out of pocket. And in many cases, I know plenty of Lifestyles Unlimited members that told me, yeah, I was doing houses for less than $5,000 cash out of pocket. Yeah. And if you had all those houses today, they would be worth a lot more than they were 8 years ago. Because part of what Tina and I benefited from is the crazy appreciation that is just starting to emerge in the Texas markets. That, in my opinion, is a fallout of the lockdown. I think it's also a fallout of just economic pressures that were placed on our economy, which now are kind of being peeled back a little bit. And demand is outstripping supply, and therefore prices are going up. And when you have more people moving into an area than you have moving out of the area, and you only have so much of a growth rate in available housing, well, people will compete and make the prices go up. And that's part of the reason Tina and I decided to sell. It was a great opportunity for us to step away from what we were doing and transition to the next phase of our life. I mean, literally, we sold into a rising market and we bought the replacement property in the rising market. But check this out. Even if I use today's numbers, for instance, there's a house that caught my eye that Jeff sent me. He's one of the realtors that I have a relationship with. And this property has an ARV of $145,000, but you can buy it for $100,000 because it has some issues. Now, it's going to take about $30,000 to fix it up. You're going to have about $10,000 worth of closing and holding costs. And when the dust all settles, you're not going to capture a lot of equity in this property. You'll probably capture maybe about $5,000 in equity, which is a little bit light. And you're going to come into this property for about $34,000. But the upside on this property is the rents that it can command. because it is in an area of Houston which is gentrifying, and as a result of the gentrification and the fact that it is positioned, once you fix it up, to make people compete for it, you're looking at about $625 a month in passive income. You heard me correctly, $625 a month in passive income. That's giving yourself a $7,500 raise every year. 22.25% return just on the cash. Just on the cash. When we come back, I'll give you the rest of the story. Stick around.
Warning. Listening to the Lifestyles Unlimited Real Estate Investor Radio Show will change your life. We will teach you how to create wealth and passive income so you can be financially free. And now, back to your host.
Welcome back to the show. All right, so I made effectively 10% per year. I mean, technically, my rate of return is infinite because I didn't put any money down on my house. But if I evaluate it based on what normal people do, it's about a 10% return. It really is. I mean, the difference is I paid a higher mortgage because I had more money mortgaged than what most people would do. Yeah, so that's the trade-off. Really, that's really what it boils down to. So instead of putting $81,000 into the property, I was just allowed to take a higher mortgage, which, cost me more money every month. But if we look at the deal that Jeff sent me, the property, again, is worth $145,000 all fixed up. Now, your cash out of pocket to do this deal is going to be about almost $34,000. And this particular property, because of the area that it's in, is really getting some attractive rents. We anticipate the cash flow on this property to be about $625 per month. That works out to a $7,500 a year income boost to your household. Yeah, $7,500. And even with putting almost $34,000 into this deal, the cash on cash return works out to be 22.25%. You heard me correctly. That's a 22.25% return on investment just on the cash. We haven't even gotten into the equity growth. Now remember, my house that I lived in, it didn't pay me any money. As a matter of fact, I paid money to the house to live there. And I paid more money to the house than most people do because I leveraged 100% of my purchase. But this rental property, it throws off cash. It throws off a lot of cash. 22.25% just on the cash is probably a lot better than you're doing in the stock market, regardless of where the stock market's at today. Now, the other thing this property is going to do, it's going to go up in value. Now, there are periods in our history where real estate has gone down in value. That's true. It has happened. But I don't think that's happening right now. As a matter of fact, I think it's just the opposite. And even when I factor my growth projections for appreciation, I still go super conservative. Yeah, I only calculate 3.5% per year because real estate has a tendency to stay ahead of inflation, and it has the tendency to double in value every 20 years. So how do you make a piece of real estate go and double every 20 years? Well, you factor in a 3.5% growth rate. That's what I do, and that's how I do it. So what is this property worth in the future? Well, just based on the growth rate, I anticipate that property going up by over $27,000 over 5 years. Now, some people would poo-poo that. They would say, well, that's not massive appreciation. Well, I never said it was massive appreciation. I said that's conservative appreciation. That's what it should do if nothing awesome happens in our economy. It it should be worth an additional $27,000 in 5 years. Now, this property is actually going to make you some additional money because you're going to put leverage on the property. In other words, you're going to take out a loan on the property because we believe in using other people's money. Yeah, you leverage other people's money, especially banks, because here's the thing, that appreciation number I just told you about, the banks don't get any of that. No, they locked in at 80% of the ARV, or I factor 75% of the ARV. There are some lenders out there that'll give you the full 80. I use 75%. And that's what the bank locks in at. Now, they're going to make their money off the amortization of the interest. And that's fine. That's totally fine. They need to make their money. That way, there's money for me to leverage. Yeah, that's the way it works. But the banks don't get any piece of that $27,000. As a matter of fact, because you're making that mortgage payment, and part of it's going to interest, and yes, you can write interest off, it also pays down the principal. So over time, more and more of that monthly mortgage payment goes towards principal reduction. Now, on a house that has an ARV of $145,000, we're not talking massive amounts of money. But over a 5-year period, that principal should go down by $8,900, and that's a conservative number. That's a very conservative number. So that's additional equity you're getting in this property. Yeah, so now you're closer to $36,000 in additional equity in the property. Oh yeah, you also captured $4,900 when you bought the deal. Not crazy great equity capture, but respectable. And to be honest with you, in this particular deal, the trade-off is the cash flow for the equity. So if cash flow is more important to you, this is a screaming great deal for you because you get more cash flow for your money. You're getting 22.25%. So you're going to get that additional money. So let's say you sell this property at the end of 5 years. It's time for it to go because you fixed everything that you could that needed to be fixed or replaced when you bought the property. You've probably had like 0 maintenance problems. But at the end of 5 years, maybe it's time for this thing to go. That's your hold period. So now you sell this property. You put it on the market, and I anticipate the future value of this property trading for $172,000. It might be a lot higher. Remember, my numbers are very conservative. Your loan balance will have paid down to about $100,000. So you're going to pull equity out of the property of over $72,000. Now, you will have some closing costs. They're going to be about $14,000. But your adjusted capital gain after 5 years is $55,600. Did I say $55,000? I meant to say $58,500. Not sure what I said. I meant $58,500. So what happened is you get all your money back, you get the captured equity back, you get all the appreciation back, and your net gain on the appreciation, once you back out the almost $34,000 you put into this deal, the net gain on this property is almost $25,000. Not too bad, is it? I mean, when you think about it, you're getting about 74% return on the equity over 5 years. So you want to know, what's that over on a yearly rate? Okay, well, this deal here is 14.7% return. So it does a little bit better than what I did in my house. Now, you might say, okay, well, there's capital gains that you're going to have to pay because you don't get that exclusion. And you're right, I don't get that exclusion. But I get something called the ability to do a 1031 exchange, so I can defer all of those tax liabilities into the follow-on properties that I'm going to buy. You heard me correctly. The total return, when you factor in all the cash flow, when you factor in all the appreciation on this particular deal, turns out to be 185% return on investment. 185% return over a 5-year period. What did I get? About 80%, right? That was over an 8-year period. So really, I only got about 50%. Are you seeing how the math works better when you invest your money correctly, as opposed to thinking that by investing in your house, that's the way to go? Your house is not an asset. It is not an asset because it doesn't pay you anything. It takes money out of your checkbook. It doesn't put money into your checkbook. That's the difference, folks. Now, think about it. $34,000, and that was just one property. If you had $81,000, you could easily buy two. Wow. That's pretty incredible. So you get about a $15,000 bump just by buying two of these houses. $15,000 increase in your household income per year off of two houses. So the question I have for you is this: how many houses do you really need? Oh, and when you start to think about replacing your income, it's not the full amount. No, if you make $100,000 a year, you got to back out all the taxes that you're paying, because with real estate, we don't pay those taxes. We don't pay the Social Security. We don't pay the Medicare. I'm telling you, this is a game changer. If you want to find out how we do it, go to lifestylesunlimitedworkshop.com. Sign up for one of our workshops, and let's get you started.
The Lifestyles Unlimited Real Estate Investor Radio Show is for entertainment purposes only. Please consult a professional regarding your personal investment needs. Nothing presented on the Lifestyles Unlimited Real Estate Investor Radio Show constitutes an endorsement, recommendation, offer, or solicitation to buy or sell any product or security.